Growth stocks or dividend stocks? This is the real question. Hey, how's it going, investors? My name is Louis Olivier, and welcome back to the North Investors, where we're all about personal finance on our path to financial freedom. You and I both know that it's super important to make money, but it's even more important to make your money works for you. So today I will share with you what is the strategy that I've recently decided to adopt concerning my stock picking and my stock objectives for the years to come in order to maximize my total value. First, guys, as you might know, there are three strategies that you can choose to maximize your investment on the stock market. First, you can decide to fully invest into dividend stocks. So this method could be very interesting for people that are looking for a stable income and a fixed income that they will receive, for example, every month. Those dividend stocks could actually be compared to bonds. The main difference between both of these tools is in the fact that bonds are usually some obligation that has a certain company or even a government towards you in exchange of a certain amount of money. And usually the minimum of money that you need to invest into bonds is of $1,000. And for example, a bond, we could say that we are buying, for example, let's say a government bond, and we are investing $1,000 in this government bond for a period of 5 years with 2% interest per year. So that means that the government will be forced and will be obligated to just give you $20 of interest per year with this bond, if obviously the value of the bond doesn't change, because the interest will always stay the same. So this is the main difference, obviously, but at the same time it makes that this type of bond, as we can see over here with this big graph representing the bonds in Canada during April 2021, we see that the interest from those bonds are really not higher than the inflation, which means that we are technically losing some power of buying, and this is not necessarily a good thing with this fixed income. However, the positive things with bonds is the fact that it's safer than dividend stocks, by the fact that bonds, it would be pretty there is like a lot like less chances that, for example, a government or a company company like that will go to bankruptcy, because those companies that will give bonds and the possibility to buy bonds will be some company that will be really well established and that doesn't really want to have a lot of growth in the future. On the other hand, you have dividend stocks company that will offer you a dividend that will variate in the time depending on the situation of the company. This is explained by the fact that the company is using their retained earnings to offer their dividends to their shareholders. And a great way to see if the company, for example, is able to pay their dividends is by the indicator of the payout ratio, which represent what is the capacity of the company to pay their dividends to the share. And basically, how does this work is by the fact that the company has their retained earnings. And for those who don't remember what is the retained earning of the company, it's basically the earnings that the company will make after all the expenses, after all the taxes and the interest that the company will have to pay. And with those earnings, the company could potentially invest into its own company to make it grow, so with research and development or others different things to make the company grow. Or the company could also use a part of its liquidity, and they will just give it straight to its shareholders, so as like a little reward. So this is the good part of the dividends, because the shareholders will have their dividends, for example, per month or per year, depending of the company. But the thing with the dividend stocks is the fact that the company, while using a lot of its liquidity, doesn't necessarily have the capacity to grow after it. So they are giving liquidity obviously to their shareholders, but they are losing some capacity to growth. But as compared to bonds, their interest and what is the dividend that they will give to their shareholders will variate compared to bonds, which it's not fluctuate and it's always stable. So this is the positive point. And as we saw with Ryokan recently in January, before the pandemic, and even in the pandemic in autumn last year, we saw that they were giving some impressive yield around, I think, 10%, but now they have cut it to be able to continue to have a great health with their company. So they have cut it, I think, to 5 or 6% of dividend. And this is still a great dividend, but they have cut it because they didn't add much liquidity left, because they were always giving some huge dividends, which was a lot of liquidities from them that was going away. And the others bad part about dividend stocks is the fact that when, as an investor, you receive some dividends, you will have to pay some taxes depending on where you live, but you will have to pay taxes on all those dividends. The second strategy that you could use in investing on the stock market is to invest 100% of your assets straight into growth stocks. So how does the growth stock companies work? Basically, what they are doing, they are using, as I told you, their retained earnings, but instead of using it and paying some dividends to their shareholders, they are using 100% of their retained earnings and they are investing it to make the company grow. So that means that they can use a certain amount of money and put it straight into search and development to increase the quality of the products that they are proposing. They could also use a certain amount and just put it to buy some new equipment, which will increase the productivity of the company. They could also decide to pay some debt that they had in the past, and they could also decide to keep a certain amount in liquidity to be able to pay some different expenses that were not planned, or for example to make some different acquisition in terms of assets. As we take an example, for example, last week we saw that the company Spotify wanted and the CEO wanted to acquire one of the big English football club, which is called Arsenal, that worth more than $2 billion, and which means that they needed to pay or to offer at least $2 billion to make and to buy it. So they need liquidity, and that's what their retained earnings are allowing them to do, because as we see here, the company is a growth stock company, so they are keeping their money instead of giving them straight to dividend stocks. So obviously this is a bit more risky than dividend stocks investing, by the fact that what will give you the profit is the fact to buy some undervalued stocks and to sell them and to sell the overvalued stocks. So you need to do a lot of researches to be sure to buy the right stocks at the right time. But that's why I think that it's a great combo and a great strategy for the people that are younger like me. And obviously you need to do your own research, because I'm not proposing you to do that, but I think that me personally, that's what I am trying to do, to find a lot of growth stocks that are undervalued, to buy them and to sell them if they are really overvalued. But on the long term, I think it's a great way to do a lot of profit very fast and to maximize your total value. And also, if we take, for example, the case of Tesla, and we compare it with another dividend stocks company during the crisis, we see that Tesla took more than 800% during the pandemic, because at the beginning it was around $100, as we can see, and it went to almost $900 per share. So it took a lot of value compared to some other dividend stocks that obviously lost some value, but the loss was a little bit less than growth stocks because they were less affected a little bit depending on the field and on the stocks. But this is the big danger of growth stocks, obviously, is the fact that there is no safety, I would say, for the investor, and they are not receiving some dividends. So you need to buy some undervalued to sell the overvalued. And also the big positive point I'd say is the fact that you are technically not paying any taxes on growth stock except if you sell the stock. So when you sell the stock, you will pay some taxes, which is basically some capital gain taxes that you will need to pay when you sell your stocks. The third and last strategy is to invest as an hybrid strategy, which is a mix between the two second strategies that we saw, which is actually the way that I personally invest. So basically that means that you will allow a certain percentage of your assets straight into growth stocks and another percentage straight into dividend stocks. And in my case, I am allowing around more than 90% of my assets straight into growth stocks. And the strategy behind it is the fact that at the moment I'm still quite young. I'm 22 years old, so I'm trying to build really a big value, and I really want to increase my value as fast as I can. And I don't need a lot of fixed income at the moment, except when I'm gonna be, not this summer but next summer, when I want to acquire another like big real estate property with some of my partners. But at the moment I don't really need some fixed income, which means that the idea that I have is that I want to buy some undervalued stock, as I told you earlier, and I want to keep them and on the really long term and let them take some value. So after, I'm going to increase my personal value, and when I'll be older and I'll need, for example, fixed income, I will take my some of my growth stocks and I will try to sell them to be after able to invest them straight into dividend stocks. And this depends, obviously the strategy that you will personally take depends on many factors. So it depends on your age, your tolerance of risk, and your personal objectives. So you will need to fix it by yourself and see what is your personal what is the strategy that you want to take personally. But to me, this is the best, I would say, the best strategy for me, obviously. And this is a strategy that helped me to maximize my net worth. And as we see with this article, this basically is an article that will show people what is the importance of growth stock, because sometimes people are kind of afraid of them and they want to invest only in dividend stocks by the fact that dividend stocks are safer and are offering, the companies are offering to the shareholders a certain amount of money to come, but the growth stock, they are not. This amount doesn't come straight to the shareholders by the dividend, but it comes from the value of the stocks. So that's why it's super important, if you invest into growth stock, that you do your research to be able to find the great stocks, and you can decide of the ponderation and what is the proportion of your portfolio you want, for example, to invest in growth stock or dividend stocks. Now, as I told you in my previous video, I want to do a full week of uploading during this summer. So I've decided to do this super week during the 1st July and the first week of July, which is, I think, since the 4th July. So I'm gonna do a little week. So during all the week, I'm gonna do some video and I'm gonna share with you what is the present series that I'm working on. So I'm gonna share it with you guys. And another thing that I've thought during the past week is that I could do some potential lives one time a week, probably on a Friday night or maybe like on Saturday or on Sunday, where I make a little summary about everything that happens on the stock market and where we can talk together and discuss about what is going on with the stock market and what are the key events that happen during the week in the financial world. So guys, tell me in the comment section if you want or not to have this idea of live streams. And also I want to know in the comment section, guys, which type of investor are you? Are you more a dividend stock investor or more growth stock investor, or you're more an hybrid type of investors? So tell me that in the comment section. And for everyone that is new, I will invite you to just come join the North family. It's totally free, obviously, and you will be aware of all the future videos that are coming up soon on the channel, so you can subscribe to the channel if you want. And also, for those who are wondering how can I do my stock analysis and how can I analyze my different stocks, well, I invite you to go check out my video on stock analysis. That is gonna be just right over here, and I will see you there.